Hello, and welcome to our Q1 2025 investment briefing from us here at Gemini Asset Management. The first quarter delivered a mix of geopolitical surprises, shifting monetary policies, and a historic recalibration in equity leadership. Whilst risks abound, opportunities continue to emerge for disciplined investors, so let's unpack the key developments across major markets. We'll cover the Wild West over in the US, equity market performance, the performance of the bond markets, and the normality of volatility. Let's dive straight in and look at the biggest story of the quarter, the US market. On screen now, you can see a chart showing the US equity market performance in Q1 2025. The best performing major equity market last year, the US, has been on a rollercoaster ride so far in 2025. The US market began strongly, and it finished nearly 4% up in January, driven by optimism around AI and resilient and positive economic data. However, in February and March, we saw a sharp reversal, with the US market finishing the quarter down nearly 8%. It's a stark difference to the exceptional 27% it generated in 2024. The main reasons for this notable decline were reassessments of the Magnificent Seven valuations, which were previously pushed high as investors backed companies that looked set to profit from the AI arms race. Interestingly, it was a China-backed AI company, DeepSeek, that originally set the catalyst to pitch into January. The release of DeepSeek's low-cost AI model famously knocked off roughly $600 billion off NVIDIA's valuation, the previous AI market darling. Crucially, another factor affecting the US market was the elephant in the room, Donald Trump's tariff policies. What started off when he came to power for the second time as strong optimism about US prospects quickly soured as markets realized that the Trump administration would play hardball on their tariff policies. Whether these were used as negotiating tactics to further US interests or not, the flip-flop nature of the tariffs led to the impression of chaotic policymaking, as they were both imposed and retracted in short order. Now, markets hate uncertainty, and the more uncertainty, the more skittish they become. This has truly been the case so far in 2025. Not knowing which way the Trump tariffs will go has substantially rocked confidence and economic forecasts. There are, however, some positives to take from the equity market performance in 2025. Shown here by chart 2 on screen now. Europe tended to outperform on the back of substantial stimulus announcements, focused mainly on the defence and infrastructure sectors of the economy. These stimulus announcements point to a turnaround in the region's potential growth outlook, and markets have bounced on the back of this. Also of note, the UK has performed relatively well as well, posting gains of 6.1% so far this year. High levels of financial and defensive sector exposure in the UK market has helped as interest rate cuts expectations again failed to materialise and potentially negative economic pressures continue to build. Asia and emerging markets were relatively flat on aggregate, but there were some nuances that's worth highlighting. Specifically, there's been a reversal in the countries which performed well and the countries that performed poorly so far in 2025. China recently performed exceptionally well on the back of refocused stimulus within the consumer sectors, whilst India and Taiwan performed poorly based on valuation and growth fears in the case of India, and on trade tariff concerns in the case of Taiwan. Now, if we move on to bond markets, chart 3 on screen now shows the performance of the major global bond indices, and you can see there's been some rather large swings here too. The story is one from growth fears and rate cut hopes to shifting focus onto inflation worries. Surprise, surprise, much of this story has been dominated by news over in the US, again. At the start of the year, the Federal Reserve has been expected to cut interest rates by 0.5% in 2025, which is shown here on chart 4 on screen now. Then, the slight cracks that were showing in the US economy were propagated further on the back of difficult news on tariffs and consumer sentiment. Now, as long as these cracks stay relatively mild, which based on current data continues to be the consensus view, then they may serve as a useful shake-up. The slight weakening in the US economy could well be a useful catalyst for the Fed to start pulling down interest rates faster than what had been expected at the start of the year, which has historically been a useful thing for asset prices. Typically, equity and bond markets don't like high interest rates, and it may well prove to be positive if the Fed does indeed cut rates further. Current expectations are shown here on chart 5, which is on screen now. Note the changed expectations for the US from the start of the year. It was expected that the Fed would cut interest rates by roughly 0.5%, but now markets are pricing in cuts of roughly 1%, which in bond markets is a relatively big move. The question now is, will bad news be good news? It's too early to say with much of a degree of confidence. And in my time of managing assets, I've learned to stay well clear of talking in absolutes, especially when it comes to financial markets. It's abundantly clear that nobody has a crystal ball with perfect foresight. But what we do know now, though, is that markets can be volatile, irrational, and prone to a good panic once in a while. So chart 6 on screen now tells this story perfectly. The data on the chart goes all the way back to 1980, with the bars on the chart showing the total return generated by the US equity market in a given calendar year, and the red dots below the zero line showing how much the markets fell during that same year. For example, we can see that in 2020, the US equity market was at one point down 34%, shown by the red dot. However, even in that cauldron of uncertainty, the US equity market not only made its way back to the positive grounds, but also finished the calendar year up by returning a pleasing 16%. When we look more deeply into the data, we see that on average, the US equity market has fallen by 14.1% in a year, but whilst that's uncomfortable at the time, in 76% of the cases, it's gone on to produce positive returns at the end of that calendar year. Here at Gemini Asset Management, we try to see through the noise and look at things in a calm and objective way when making decisions in the portfolios. We have the humility to say that we don't really know how things are going to play out with any certainty, but we do know that we can lean on our tried and trusted investment process to help navigate the winds, both in the good times and, potentially, in tricky times that may lie ahead. If you do have any further questions at all, please feel free to reach out to your financial advisor. Thank you for watching, and we'll see you again next time. Thank you.